Hello students, today we are going to study Cbse Class 12 Business Studies Chapter number 9 Financial Management. In this chapter, we will try to understand more about business finance, which is nothing but the money required for carrying out all types of business activities. Financial management is nothing but getting a deep insight as to how any business organization will be able to procure funds for short-term as well as long-term usage, as well as make sure that these funds are optimally utilized such that it will give maximum benefit. The main aim of implementing financial management in any business organization is to reduce the cost of funds that are being procured. That means from various sources that we are bringing in the funds for the usage of the business firm, it has to be ensured that the costage is minimum. Calculate the risks and make sure that whatever funds we are bringing in have the minimum risks as compared to other sources, as well as to achieve effective use of these funds. It also ensures availability of funds whenever it's required, but at the same time it has to avoid idle funds. So any business organization should not accumulate idle funds, but at the same time ensure that whenever there is a requirement, the funds are readily available. Let us now look at the role of financial management in any business firm. The study of any organization will help us understand that the size as well as composition of fixed assets of business is very important. That means that if there is an increase in the capital budget, there will be an increase in the fixed assets, because capital budgeting decisions are directly related to the fixed assets of an organization. Now, if there is an increase in the fixed assets, if the investment of a firm is it's high in fixed assets, that automatically there will be an increase in the working capital requirement, because obviously if you are trying to invest more in machinery or land or any of those fixed assets, it means that the working capital requirement in order to ensure that these fixed assets are being properly or optimally utilized will also increase. That means the quantum of current assets as well as its breakup into cash, inventories and receivables. Working capital is nothing but the capital that is required for the financial year of an organization. So here financial management will help to understand the decisions about credit policy, inventory management, and the number of debtors, and all these will somewhere contribute towards the current assets. The effect of long-term and short-term financing to be used is also another important role played by the financial management of an organization. So if there is an organization which seeks to be more liquid, then it should automatically have more long-term finance, of course based on the assumption that current liabilities cost less than the long-term finance. So basically, if you want to be more liquid as far as the firm is concerned, then there should be ready availability of finances such that the liquidity or the proportion of or the inflow and the outflow of quick inflow and outflow of money is substantial. The next role played by financial management is the total proportion of debt and equity in the long-term finance, which is of course called as the capital structure of an organization. Other key decision areas include all the other items in the profit and loss account. For example, increase in debt means increase interest expense, increase in equity means increase payment of dividends. Of course, all these come as a part of the capital structure decisions that has to be followed, and we shall be studying in detail in the upcoming slides. Let us study the objectives of financial management. First, profit maximization. Now, every firm should select any asset or project or make decisions that are profitable and reject those which are non-profitable in the long run. That is what basically profit maximization means, that either it is in terms of fixed assets or any kind of investment decisions, or in terms of any kind of long-term or short-term projects, the firm should ensure that all these decisions are profitable in nature to the business firm. Minimizing the risk, they should always ensure that a very careful analysis is done regarding the future strategies of the business organization. At the same time, the financial policies that are developed should be safe and sound, and there should be enough reserves to ensure that any kind of unseen circumstance is carefully taken care of. Obtaining funds at minimum cost. Whenever the funds are being procured in any organization, again it should be carefully analyzed and studied such that wherever the funds are coming, whatever the sources of funds are being studied, one should ensure that these are at the least available cost. That means that there has to be a proper comparison between the various sources, and they should also ensure that there is value addition of the procurement of the funds, as well as of course the reduction in the cost. Shareholders are considered the backbone of any business organization. So it is very important that through financial management, wealth maximization is also considered. The firm should plan to maximize shareholders' wealth, not only because the shareholders, of course, they will spread across and it brings in a lot of goodwill, but at the same time, this kind of satisfaction that is there between the shareholders will somewhere determine the market value or the price of the shares in the market. The top level management of any business organization has to make certain very crucial financial decisions that will impact the business firm not only in the short run but also in the long run. Now these decisions are basically divided into investment decision, dividend decision and financial decision. Let us now look at the investment decisions which are of key importance to the management of any business organization. Now it is very obvious that as far as finances are concerned, the resources are always less as compared to the uses. That means that you can never say that you have enough funds or ample funds. Funds can always be put to use, and any amount of funds are always welcomed by the business organization. Now whenever these resources are identified, the next important decision lies whether which area these resources have to be put to use, such that they give maximum possible return for the investors. Now these can be either long term or short term. The long term investment decisions are known as capital budgeting decisions, which will somewhere affects the finances of an organization in long term business. Now of course these decisions affect the earning capacity over the long run and also involve huge amounts of investment, and such decisions are irreversible in nature. That means once you have identified what kind of investments or how much of these investments go towards the fixed assets, such decisions cannot be reversed. Taking a simple example, suppose a firm has decided to purchase a particular kind of machinery. Now, investment in machinery is a long-term decision. Now, having used that machinery for 6 months, the firm cannot go back on its decision and want to change it again, because, of course, it will not be, beneficial to the organization. Then there are short-term or the working capital decisions, which are related to cash, inventories and the debtors. Now these decisions affect the day-to-day working of business and also affect the liquidity and profitability of a business organization. The main areas of interest for the working capital decisions include the cash management, that is the inflow and the outflow of cash, inventory management with respect to raw materials as well as the products that have already been produced or the output, and of course the receivables management in terms of your debtors. Since we already said that capital budgeting decisions are irreversible in nature, it is also very important to identify the factors which affect these capital budgeting decisions. These include cash flows of the project, wherein the amount of cash receipts and other payments are carefully analyzed and calculated. The rate of return, where again a careful analysis is done with respect to the return from each of the proposal and also the risk involved in investing in such proposals. And finally, investment criteria which is involved, that is calculation of the amount of investment that is there with respect to each and every project, the interest rate that has to be paid, the cash flows and the rate of return. Now, in order to be able to make the best possible decision related to capital budgeting, there are many techniques that are used by business firms such that there is maximum return or maximum favorability with respect to a business organization. The next important aspect of decision making for the management of a business organization are the financing decisions. Now, these decisions involve identification of the various sources of finance. Of course, when we are talking about the sources of finance, we can broadly classify them into shareholders, that is the owner's funds, or the borrowed funds. The shareholders' funds are further classified into equity and retained earnings. Now, what happens if there is a shareholders' funds? What is the kind of impact on the business organization? The impact is there is no particular commitment regarding payment of returns for the shareholders in the form of dividend, or there is no urgent necessity to repay the capital. But at the same time, we have also seen that somewhere wealth maximization, that means if the firm is able to keep these shareholders happy, somewhere it will affect the overall value of the shares of the company. The borrowed funds include the debentures and other forms of debt. Now, what is mandatory with respect to these borrowed funds is the interest component has to be paid irrespective of or regardless of the profit that the firm is making, as well as the borrowed fund as such has to be repaid after a fixed period of time. Now, the risk as such is always there with respect to the default on payment. What if the company is not able to generate enough revenues even to be able to pay this fixed component of the borrowed fund? So the smartest thing as far as a firm is concerned lies in a judicious mix of finances in terms of debt, equity, preference shares and retained earnings. Of course, debt is considered the cheapest source of finance because of the fact that whatever component of interest that is being paid towards repayment of debt is tax deductible in nature, and of course that makes it a cheaper source of finance. But at the same time, the flotation cost, that is the cost to procure these funds, should also be kept in mind while evaluating the different sources of funds. Let us quickly look at the factors that affect the financing decisions. First is the cost. The smartest decision for any management in a business organization is to opt for the cheapest source. The risk, which have to be calculated and individually, as far as individual components are concerned, it has to be calculated. The flotation cost, the higher the flotation cost, lesser attractive is the source of finance. Cash flow positions, which will somewhere help to identify how strong or how capacitated the firm is in repaying the debt component. So obviously stronger cash flow means that debt financing is a more viable option. The next is the level of fixed operating cost. Now, if suppose the fixed operating cost of a firm is high, which means that more finances are going towards these operational expenses, then it is smarter to involve lesser debt financing or in terms of debt, because like I always, I had previously also mentioned that debt is something, the component of which has to be repaid irrespective of the profit that is the firm is making. Control considerations have to be also made by the management of the business organization. Whenever equity is included in the firm, it means that the control is being given or it is being shared amongst the shareholders. So again, that is a very important key area of concern for the management of a business organization. And finally, the state of capital market. If the stock market is bullish, then that means more people are willing to invest. If more people are willing to invest, that means there are chances that the equity portion or the proportion of fund can be increased. The component of equity can be increased in the business organization. The dividend decision for the management of any business organization mainly aims to understand what portion of the profit has to be distributed to the shareholders. Now, the decision is to identify that amount which should be paid to the shareholders in the form of dividend, or whether it should be kept as retained earnings. Now, if the firm pays the dividend, then it also constitutes the current income which is being reinvested through the dividends. The shareholders will probably be reinvesting these dividends. And if it is retained earnings, then the firm's future capacity of earning will be increased. So it has to be a very wisely calculated decision by the management of any business organization. Let us understand the factors that affect the dividend decision for the management of any business organization. First is the earnings. That means, are there enough earnings to be able to pay as dividends to the shareholders? That has to be checked. Then the stability of earnings. Are these earnings stable enough? If they are, then of course higher dividends can be paid. The stability of dividends. If suppose the firm is known for providing stable dividends, then that also should be kept into consideration. The dividend per share is not altered if the change in the earning is small or temporary. If there is hardly any change in the earnings, then obviously dividend per share should not be altered. I always say that if you remember, the dividend decisions are policy decisions of the organization. Growth opportunities. If suppose there are better growth opportunities that the firm is seeking in the upcoming months or in the upcoming time period, then the retained earnings should be given more preference over the dividends to the shareholders. Cash flow position of the firm has to be considered, because paying dividends means there will be an outflow of cash. Shareholder preference is also to be considered, because many a times it so happens that the shareholders as such of a particular firm make this as a source of their income, and they keep on expecting that the firm pays regular dividends from time to time, so that it will be a part of their income for the future. The firm should also consider the taxation policies. Now, for example, if the tax that is being levied on the dividend is high, then obviously it makes more sense to pay less dividend. Next is to identify the stock market reaction, because we were previously discussing, any payment of dividend will be considered as a good news among the shareholders, obviously, because it is kind of an income for the investment that they had made in the form of equity. Now, this will somewhere affect the net asset value of the shares in the stock market. Access to capital market is another factor, where the companies want to they tend to get easy access into the capital market by paying more dividend. There may be certain legal constraints like the provisions in the Companies Act, which may place restrictions on the amount of dividend that is being paid out by the firm. And of course, there may be contractual constraints. That means, if suppose there is a borrower who has given money, or the borrower's funds, where a person has given money to the organization, he may have some kind of restriction on the payment of dividend through some kind of a loan agreement. There is a lot of deliberation amongst the top level management with respect to financial planning in any organization. This planning involves nothing but preparing a financial blueprint for the future operations of the firm. Their main aim is to focus on the fund requirements as well as the ready availability of these funds. Through financial planning, even the budgets are formulated, which give a detailed financial plan of action for a period of 1 year or maybe a little less with respect to a particular project. The process of financial planning involves preparation of the sales forecast and as well as preparing all the financial statements that are required for the financial term of a business organization. Then the investment in the fixed capital and the working capital, what are the kind of funds that are required towards the expenses of the firm, and also calculating the estimated or the expected profits in one financial year, and then identify the internal and the external funds and the availability of these funds, as well as to identify the sources of the external funds. Of course, internal funds is something which are there within the purview of the business organization, but if they're looking for any kind of external funds, even they need to be identified, and also preparation of the cash budgets so that the firm is able to manage the inflow and the outflow of the cash. The objective of financial management is to ensure availability of funds whenever required. Now, this involves estimation of the volume of funds that is required, the time that is required in order to procure these funds, as well as the sources of funds. Now, if suppose it is debt, so from which sources this debt factor can be procured, from where you can borrow the funds. If it is equity, then from where you are going to generate that equity. If it is retained earnings, then what volume of funds are going to come from these retained earnings. So all these sources have to be identified through financial planning. The next objective of financial planning is to ensure that the funds are not idle, because idle funds are probably the most dangerous aspect of the growth that affect the growth of a business organization. So the financial department has to come up with the best possible use of the surplus money, or whatever the money which is not immediately required, and it has to be made put into best and the most effective usage. This way they can also ensure that the idle funds are not adding on to the cost of the organization. Financial planning plays a pivotal role in the sustainability as well as the growth of any business organization. It helps the firm to be better prepared for the future. It ensures that the firm is again prepared for any kind of shocks and surprises that can come in the near future. Through financial planning, all the policies and procedure with respect to the financial aspect of a business firm are clearly defined, which will again further lead to better coordination amongst the various business functions. It reduces any kind of waste, duplication of efforts with respect to the finances of a business organization. It also helps to link the present to the future. That means from where we are to where we want to be. It creates a key link between investment and financial decisions. And of course, through financial planning, detailed objectives are provided to the business organization, which will again help in better control, wherein the actual performance can be measured and it can be seen with respect to whatever the standards that have been set with respect to the finances of a business organization. Hence, we can say that financial management involves a series of functions with respect to the financial aspect of a business organization, in terms of planning, in terms of organizing the funds, in terms of distributing and allocating the funds, and also trying to understand whether the usage of funds is as per the standards that have been set, or probably what we can term as the budgets, which have been set at the time of planning. So in that particular way, financial management is again a very important aspect for the development of any business organization.